In this video, we're going to go through some lender terminology. So terms used by lenders, it's good to know. It's kind of industry standard terms, so you're going to hear this no matter where you are. Let's dive into it. So the first one is LTC and LTV. So LTC is loan to cost, LTV is loan to value. Often interchangeably used. The technical definition varies slightly, but in the industry, if you say LTC, but really meant LTV or vice versa, people shouldn't really give you too much grief for it. People will know what you're talking about. So LTC and LTV is the percentage of the either purchase price or the value of the property that you will be financing. So for instance, in multifamily, depending on what economic conditions are, you could get financing for 70, maybe 75% of the actual cost to purchase. That would be LTC, so loan to cost. When you're actually purchasing a property, the technical correct term is loan to cost. LTC. So you could borrow 70 to 75%. LTV is more to do with value, loan to value, and more to do with refinances. So when you refinance a property, you're getting a percentage of the value of the property. So you're not selling it, so there is no cost. So it's same kind of equation, 70 to 75% is about as much leverage as you can get on a property. So for $1 million property, you're looking at about a loan of $750,000. So that's LTC, LTV, pretty straightforward. They do go up in good times, so you are able to leverage more in good times. So in multifamily, you could maybe even see like 80, 85%, maybe even higher. In tough times, especially when lending is pretty risky, that may be scaled back to 60, 55. But we're always talking about percentages compared to the value or purchase price of the property. Next term is collateral. So collateral is effectively the safety net for the lenders in case you default on a property. In real estate, the collateral is almost always the property itself. And it is why banks generally like to lend to real estate. Real estate seen as a relatively safe asset, and worst case, if it goes into default, they have a pretty good idea of how much value that's sitting on. They can put a property manager in place. That's collateral. For most properties out there, the property itself that's getting the loan will be good enough. You'll also probably be expected to put in a personal guarantee that if it does go into default and the property doesn't cover the value of the money owed to the bank, you would be on the hook to make the difference up. There's also cross-collateralization. So in that scenario, I've seen this a lot on vacant buildings where they're not making any cash flow. The lender will still lend to the property even though it's not producing any income, but it's saying, hey, in case of you going into default, I don't want to be stuck with this property that has expenses but no income coming in. So I want to cross-collateralize it, meaning I want to be able to take another one of your properties in the case this first one goes into default. So that's cross-collateralization. Next term is recourse and non-recourse loans. So recourse means that you're signing a personal guarantee on the property. Non-recourse means that you don't have a personal guarantee. So the owners of the property aren't personally on the hook if it goes into default. Recourse loans, you're typically able to get a higher LTV, so you could get 70 to 75% LTV. on a recourse loan. On a non-recourse loan, you're typically dealing with a lower LTV, maybe 60-65%. And the reason is that's de-risking the lender a little bit because they're not getting that personal guarantee. So that's recourse and non-recourse loans. Default is the next term. So most people think of default as missing a mortgage payment or missing several mortgage payments and the bank coming and taking the property. But in commercial real estate, default can mean a lot of things. Yes, missing payments is typically the main one, but even any breach of the loan terms can be considered default. So not submitting paperwork, usually the banks will request that you submit paperwork every year just to see what the financial performance of the property is. Submit tax returns. If you don't do that, you could be in default and the lender could either fine you or take the property from you or call the loan due. So it's not submitting paperwork. If income levels in the property fall below an agreed upon amount, the lender could put you into default. You technically are in default as soon as that happens. You could get other loans that aren't approved by the lender. So you could get mezzanine debt, which is just a higher rate debt to cover some payments. You could get a personal loan, whatever it is. If it's not allowed per the original loan documents, then you are in default. So it's just not making mortgage payments. The next one is DSCR, which stands for debt service coverage ratio. This is a simple equation. It's NOI over the annual mortgage payment. So we're really comparing how much money the property brings in as a ratio to the mortgage payment. So if you had a DSCR of 1, that would mean that all the money you're bringing in, NOI, after expenses of course, pretty much is the same as the cost of the loan payments. So in that scenario, it's not very good. The banks typically don't like that. They may look for a specific debt to service coverage ratio. I've often seen 1.3 as a kind of minimum that banks will lend to. Of course, they could go a lot lower for various other reasons, but in 1.3, it means that your NOI is over the actual mortgage payments, and you have a little bit of a buffer zone where you can actually take some of that as profit. Even if you lose a tenant, you're still able to make mortgage payments. So DSCR is it's a term that really only banks use, but it's a good measure as well of how much of my income is being eaten up by mortgage payments. You don't want to let that get too out of hand. So DSCR, debt service coverage ratio. Next term is term. The actual name of it is term. And when we're talking about term, we're talking about how long the loan is for. So is it a 3-year loan? Is it a 5-year loan? Is it a 10-year loan? In commercial real estate, a term is usually, it can be any time really, but more common is 3 to 5 year terms. So unlike a mortgage on a house, which is maybe 15 years or 30-year term, commercial real estate loans are typically a lot shorter. They're 3 to 5 years. You can get some as long as short as 1 or 2 years, some maybe 10 years. But 3 to 5 is pretty common. Next one is amortization. So amortization kind of goes hand in hand with term. A loan is made up of interest and principal pay down. So when you make a payment, part of that is interest, part of that is principal pay down. Really, when we're talking about amortization, we're asking making minimum monthly payments, how long would it take to pay down the principal of the loan? Again, back to a residential house mortgage situation, we're talking about a 30-year term with a 30-year amortization. So at the end of the 30 years, if you make the minimum payments, it's going to be all paid off. So amortization is how many years, what time period making these consistent payments would it take to completely pay off the loan. Where it gets a little bit more complex in commercial real estate is that the amortization, unlike residential, typically does not match the term. So in residential, you have a 30-year term, you have 30 years to pay off the loan, and a 30-year amortization, meaning that if you make all the payments by the end of the term, you're going to be down to zero balance. 15-year term matches a 15-year amortization. If you make all the payments over 15 years, you're going to be down to a zero balance at the end of that 15-year term. With commercial real estate, as I said before, we're typically looking at terms of 3 to 5 years, but the amortization may be a lot higher. So I would typically see the highest amortization in commercial real estate as being about 25 years. So for a typical loan, you might say, hey, here are the term is 5 years, but the amortization is 25 years. Really what we're saying at that point is that the mortgage payments match a schedule, which if you went for 25 years, you'd pay it down to zero. However, the loan's only going to go for 5 years. So after 5 years, you're still going to owe money. You still have 20 years worth of payments to be able to get down to zero. So you still owe money at the 5-year mark. The loan is over. You have to pay back the remainder, whatever's left over. So either you'd have to sell the property or refinance or just pay off the loan with cash from an outside source. So that extra leftover money is the next term, what we call a balloon payment. So balloon payment, excess principal yet to be paid down at the end of the term. So that would be what a balloon payment is. Next one, floating rate loan. So most of you, especially if you've worked with houses, you're typically used to a fixed rate loan. A floating rate loan means that the rate you're paying actually moves. So it's usually based on say the prime rate, which is a rate established, very low interest rate established, and that goes up and down with interest rates. It's a standard mark. And then the lender will typically add maybe a 1% or 2% onto that, whatever you're able to negotiate. And if interest rates go up, your loan is going to go up, so your mortgage payments are really going to go up in real time as well, and vice versa if it goes down. Usually there's a floor, so you're not going to get super low if interest rates do get low. But that's what a floating rate loan is. Again, more common in commercial real estate than it is in residential real estate. Prepayment penalty. So a prepayment penalty is another thing to watch out for in commercial real estate. When you're refinancing, say that interest rates drop to a lot lower level than what you're currently paying, you can refinance, yes, but if you've just got a loan, there may be prepayment penalties. So I've seen a structure of like a 3-2-1 on a 3-year loan. So in the first year, if you prepay the loan, say you've refinanced to a lower rate, you're going to pay a 3% penalty on the balance of the mortgage. They're really there for the lender to ensure that they're going to make some money on the deal. They do all this work on the front end to try and get the deal together, and then if you suddenly a month later sell the property or refinance out, that's a lot of revenue that they were counting on that they no longer get. So that's why these penalties are in place. It's important to know when working with investors or people looking to sell, if they do have a prepayment penalty, they may take that into consideration when negotiating a price they're willing to take for a property. So it's important to definitely keep an eye on those scenarios where there may be a prepayment penalty involved. So I have the next one here is mortgage broker. A mortgage broker is an intermediary connecting investors with lenders and collecting a fee. With smaller deals, it's usually, and when I say smaller, I'm talking maybe up to $1 million. It's probably worth going to a lender directly. With a mortgage broker, they will actually be shopping out a deal on your behalf or on the investor's behalf to a number of different lenders, finding the best rate, the best terms, whatever's needed. If it's a quick close, they'll go to the person who's able to close the quickest. So those are the lending terminologies we have